Thank you to everyone for joining us today. The slide deck can be found in the handout sections on your webinar toolbar. Please use the question tab on the right-hand side to ask questions throughout the presentation. We will be holding all questions for the end. We are also going to be sharing the slides and the presentation video recording link following the live presentation. Thank you, and here's your presenters.
Good afternoon, everybody. My name is Frank Boudelette. Thank you for joining our webinar on PPP Flexibility Act and some loan forgiveness. Last night or early this morning, a new IFR came out, which we've feverishly incorporated into this session today. The first, I want to just give the disclaimer that this information is for purposes for this seminar and should not be substituted for actual individual tax advice or qualified tax advice for your specific situation. And these are the views of the presenters and Witham Smith and Brown, and should be taken in consideration. So today our presenters, there I am, Frank Boudelette, team leader. We have Chris DeMeo, partner, practice leader, technology and emerging growth services. Dan Mayo, national lead on federal tax policy, and Matt Walsh, team leader for the SBA assistance program. His great looking guys right there on the screen. You can go to the next slide, please. Okay, so the guidance issued since the PPP Flexibility Act that came out on June 5th. So June 5th was only about less than 3 weeks ago, and already there's been a lot of action. So they passed a interim final rule on June 11th. Then they had a couple more IFRs that came out. The one on the 12th was actually an eligibility requirement, reducing the look-back period for felons. So if you were a felon more than 2 years ago, you're okay to apply for the loan. The IFR in 17, June 17th came out and then incorporated some more of the Flexibility Act into it. It also solidified the $46,154 compensation for the 24 weeks that was increased, and we'll talk about the changes in that Flexibility Act. And then the two more forgiveness application forms came out on the 16th. Then they pulled them and put them back out. And then on the 23rd, which was today, the new IFR came out, which we're going to discuss and we incorporated into these slides. So the next slide, please. So the PPP Flexibility Act of 2020 was enacted on June 5th. And what this did was it changed the covered period. It increased it to 24 weeks. So now it's automatically 24 weeks unless you elect the 8-week period for loans that were issued before June 5th. If you received your loan after June 5th, you don't have the 8-week option. You have to use it 24 weeks. The rehire rule for the 8-week and 24-week covered periods, the FTD and wage reductions can be cured on or before December 31st, 2020. June 30th no longer applies for those. Next slide. And this is just an overview. We're going to get into more detail on each of these items as we go in. So for the Flexibility Act, the maturity date. So now for loans issued on or after June 5th, they automatically have a 5-year minimum maturity date. You can get longer if your bank will allow it, but you will have a 5-year maturity date for any loans after June 5th. If you received your loan prior to June 5th, you are allowed to negotiate with your lender and change it from a 2-year payback to 5 years. So you're permitted to do that, but you have to discuss that with the lender, and you guys can come to an agreement. You can get a 5-year term. The payment deferral for principal and interest extends the deferral period to the date that the SBA remits the loan forgiveness amount to the lender. We'll talk about those dates. Some things changed a little bit there on when you would get the forgiveness, the actual forgiveness. If no forgiveness is sought, then the payments will begin 10 months after the end of the covered period. So you have 10 months to apply for forgiveness. The next slide, please. Okay, so the new FTE reduction safe harbors. So they added a couple more safe harbors to the existing 4. And again, I'm going to talk on a high level on these, and we're going to get into some more examples. We do think that there are some game changers here. For employee availability, the borrower can document in good faith that it had an inability during the covered period, whichever that is, 8 or 24 weeks, to rehire individuals that were employees on February 15th. And an inability to hire similarly qualified employees for unfulfilled positions. So if you had an employee that left or you let go and you want to rehire that employee, if they turn you down, you will have to notify the state within 30 days that you made an offer, the state unemployment insurance, that you made an offer and they rejected it. So you need to explain that to the employees, that if you do make a written offer to them and they reject it, that you will notify the unemployment office because you did make a valid offer. The next area, which I think is the game changer, is the business activity. The borrower can document in good faith an inability during the covered period to return to the same level of business as before February 15, 2020, due to compliance with requirements or guidance by the three agencies, the CDC, the Center for Disease Control, OSHA, and HHS, during the period from March 1st to December 31st, and relating to maintenance for the standards for sanitation, social distancing, and all that under COVID-19. So the inability can be either direct or indirect, and it's related to the federal rules, and you got to recognize that most of the state orders are based on the federal rules and guidelines. You have to document and include copies of the COVID-19 requirements or guidance for each business location and relevant borrower financial records. Now, an example, if IFR issued today indicates that the state shutdown order must reference the federal guidance. So you need to find in New Jersey, when New Jersey shut down, you need to refer to the federal guidance that the governor was referencing when he shut the state down. The safe harbor allows many borrowers to use the EZ loan forgiveness application, because here you're not able to get back to the same level of business as you were before February 15th. So you do not have to rehire all those employees that you may have let go. Also, in the Flexibility Act, the 60-40 rule came about. We changes for the 75% how to be used for payroll. Now you can use at least 60% for payroll. 40% could be for other costs, non-payroll costs, and this is not a cliff pronouncement. It's so if you have less than 60% for payroll costs, say it's 58%, you will have only allowed the 40% for the non-payroll costs will be capped. So you will have a potential reduction there if you don't spend at least 60%. But you will get some forgiveness, so it's not all or nothing. The next slide on loan forgiveness covered period. So this is what also changed here, was that you now have 24 weeks beginning on the first day of the loan. And if the 24 covered period, then the hire, rehire, restoration date is December 31st, 2020. So again, if you got the loan on April 5th, your 24 weeks will probably extend to about August, sometime in August, but you may still have to restore your employees by December 31st, 2020. Paid or incurred rule still applies to payroll and non-payroll costs. So again, you're looking for the weeks that you incurred the costs. Borrowers who received the loan before June 5th can elect the 8-week covered period. So it's automatically 24 weeks unless you elect an 8-week period. And there are cases when you might have spent all the money already in the 8 weeks. So then you can stay with the 8-week period and apply for forgiveness once the 8 weeks is completed. And in that case, your restoration date is the June 30th date. The alternative covered periods, which was enacted earlier before this, it carried over to this new act. So you can, for the convenience, administrative convenience, not use the actual, you can start using for payroll the day that your first payroll period begins. So the example is if you received a loan on April 20th, the first day of your pay period is Sunday, April 26th. You can start your 8-week period or 24-week period on Sunday, April 26th and end on Saturday, June 20th. So that's how the covered periods will be working. Not much difference, but everything just changed the 8 to 24 weeks, and everything else should basically remain the same. With that, I will turn this over to Dan, who will speak about some payroll costs.
Great, thanks, Frank. So we're going to turn now to talk about payroll costs and the definition and sort of what changed and what clarifications have come out. And there's been a lot of flux in this area, so it's this has been helpful, at least what came out today. I know the slide looks kind of busy, but we thought it'd be helpful to have the information, as you can use these slides as a reference tool going forward, since it has the latest information. In terms of, so let's look at employees first. So we're looking at non-owner employees here. The cash compensation, it does include bonus and hazard pay. They told us that a few weeks ago or a month ago. For the 8-week covered period, the cap is 850 seconds, which comes out to 15,385. For a 24-week period, when you do the math, $100,000 cash compensation cap comes out to $46,154. And then on top of that, you get to add the non-cash compensation that the employer pays for group healthcare benefits, retirement, and state and local employment taxes. So those amounts are on top of the cash compensation. So that's what applies to employees, non-owner employees. When you get to owner employees and self-employed people and general partners, you get a separate set of rules. And that's what the remainder of the slide talks about. And so if you have owner employees, self-employed, general partners, you're looking at 8-week covered period. The payroll comp is limited to the lesser of 8 weeks of the 2019 compensation, or 15,385, and that's in total across all businesses. So if you have 2 Schedule C businesses, you're limited to 15,385, or the lesser of 2019 compensation. What they don't want is you to pay yourself in excess of 2019 comp. So you get the owner gets a bonus, and then perhaps they pay their employees less. So that's what the rule is really trying to get at here. If you have a 24-week covered period, payroll comp is limited to the lesser of 2.5 months of your 2019 comp, or $20,833. And again, that's in total across all businesses. So they clarified this, which was helpful. And then they gave a bunch of these specific rules here. So we list them here. And the reason we put it here is because it really is confusing, keeping track of when retirement is included, when health is included. And there's a lot of rules, and it's been issued, drips and drabs over the past 3 months now, since, May 27th, when the CARES Act was first passed. I'm sorry, March 27th, when the CARES Act was first passed. So when you're looking at C Corps, it's capped at 2019 cash compensation, for owner employees, and they can include the employer retirement and health insurance contributions. But when you get to the S Corps, it's capped at 2019 cash compensation, and it includes employer retirement contributions, but not health insurance, because that was already included in cash compensation, assuming it was done properly. Schedule C filers, these are self-employed people who file Schedule C to their 1040 tax return. The compensation here is capped at the owner compensation replacement amount, which is really just the I think it's line 31 of the Schedule C, which is the net profit amount, the 2019 net profit amount. And you cannot take retirement or healthcare contributions; they've already been included in self-employment income. Similarly, for general partners, you're capped at the 2019 net earnings from self-employment, which I believe is line 14 on the K1, reduced by certain items there in the parenthetical. So we'll turn to the next slide, please. And these are the non-payroll costs. These are the overhead items, right? And so nothing's changed here. This is the same as back from the CARES Act statute. The only enhancement we've seen is transportation. An IFR came out about a month or so ago, maybe 2 months now, explaining that they're referring to gas for a leased automobile when they're talking about transportation costs. But we get a lot of questions on what utilities are included. The ones they are specifically listed, and they're listed here. So no other utilities is permissible other than the ones specifically listed here, assuming, again, the service began before February 15th. Next slide, please. So this is the paid or incurred. This is mostly similar to what we've seen previously. They have interpreted this in a favorable manner, as we've talked about on prior webinars. Paid or incurred, it's not and, so it's either one. So this includes 2 costs. One is costs incurred before the covered period, And sorry, trying to shut this off. Here, payroll costs incurred before the covered period and paid during the covered period. So think about that as if your covered period starts June 1st, you have an expense that was incurred before June 1st, but you pay it June 2nd. That's covered, and they allow for that expansion of the covered period in these rules. The second one there is payroll incurred during the covered period and paid after the covered period, but on or before the next regular pay date for that item. And so this is at the end of the covered period. If your covered period ends, let's just say it ends July 15th, and your next bill comes August 1st, but you pay it before that, then that you can include up to July 15th, but not after July 15th. So you can't prepay any expense beyond the 8 or 24 week period. So you can include more than 8 or 24 weeks, depending on your covered period. So if you have an 8-week covered period, you can definitely get more than 8 weeks of expenses in there. If you're using a 24-week covered period, again, you can get more than 24 weeks of expenses in there. There is no option to choose a covered period between 8 and 24 weeks. However, as I think Chris is going to talk about a little later, the IFR that came out today said that you can apply for forgiveness at any time, even during your covered period, in the middle of your covered period. And there's one quirk there about the wage reduction rule. But so effectively you can get a 10 or 12 week covered period if you have full forgiveness during that time and you want to apply early. Otherwise, it's hard to see a benefit of applying early. You know, there may be some unique situations where you want to get it over with and you're fairly confident the way the rest of the covered period is going to play out. But so for you can include more than 24 weeks for non-owner employees. That we've talked about, that's the paid or incurred. There are limitations though for overhead costs and for owner employees, self-employed, and general partners. We bucket them together here. And so for these, the owner employees, general partners, self-employed, they're subject to a cap, which is 2019 compensation, or that specific dollar amount that we talked about on the previous page. So you cannot get more than 24 weeks in for, or 8 or 24 for those particular types of individuals. For overhead costs, recall there's this 40% limitation. No more than 40% of your forgiveness amount can relate to the loan forgiveness amount. Used to be 25%. The PPP Flexibility Act enhanced that and expanded it to 40%. Catch-up payments generally are not required. But we do recommend that people include a catch-up payment if the payment would not be paid until after the first regular pay date after the covered period. So there's that rule up above that talks about if it's paid on or before the regular pay date. If you're not going to make that date for one reason or another, it should be paid during the covered period if you want to include the expense. Of course, your loan forgiveness amount cannot exceed the principal amount of the loan plus accrued interest. Nothing new here. That's the same rule. We include some of these rules for completeness just to make a complete deck. Others, we just try and include the new stuff. But so let's turn to the next slide, please. So this is really an important slide here because this is really where most people have questions, and that's on the FTE reductions. And so sort of how do you calculate the FTE reductions? What's the rehire rule? Are there exemptions or safe harbors, exceptions? We sort of put this slide together to clear it up because it's very unclear when you read through the various pieces of guidance that they keep modifying on a continual basis. So the first way to eliminate, if you have an FTE reduction, again, this is a reduction from one of your 2 or 3 reference periods. If you're seasonal, there's a third option. But there's for most people, it's one of those 2 reference periods, either mid-February 19 to end of June 19, or January to February of 2020. Those are your 2 reference periods. And so the rehire rule is one way to eliminate it. And this looks at this window period of February 15th to April 26th. And if you have reductions during that period and you restore it by, it's now December 31st. So this is, we should have caught this on the slide here. The June 30th date is now gone. As long as, and you might have heard from prior guidance, they had a snapshot approach to the way they look at this. They no longer do that. The date is now December 31st if you use an 8-week period or a 24-week period. So as long as you restore them by December 31st, you can eliminate the total reduction relative to the reference period just by reducing the elimination during this window period of February 15th to April 26th. So nothing's changed on the rehire rule other than that date's been moved out to December 31st. But again, that change was made this morning, so in the IFR, so which is why we rushed to get the guidance in here. But we will update the slide deck so you have the final version. So after the rehire rule, the second way to eliminate the reduction is through these FTE safe harbors, and Frank talked about these before. The first one's based on employee availability. The second one's based on business activity. I won't go through them again, other than just to highlight that these are called the safe harbors, and this is what the application refers to as a safe harbor. Then there are 4 FTE full-time equivalent exceptions, and the SBA guidance sometimes refers to these as exemptions. The application refers to it as an exception, which is why we call it that here. And these are 4 exceptions that came in prior SBA guidance. They're not new, although the first one was modified in the IFR that was issued this morning. And it talks about employee hours that were reduced and the employee refused an offer at the same salary or wage to restore the reduction in hours. This used to be relating to wages too. They've sort of eliminated that and figuring and stating explicitly in the IFR that that's subsumed in the employee availability safe harbor. So they modified that first one. Turn to the next slide, please. So these are, we put key points here in the FTE reduction calculation. These are questions we get from clients quite a bit. So we put them in here just as a reminder to people and thinking they'd be helpful to a broader base than, because we get these questions somewhat commonly. The first one is that when you have your FTE calculation for the reference period, again, those are those 2 periods, either mid-19 or early 2020, or third if you have a more flexible option if you're a seasonal employer, that is static. And so there are no adjustments to the FTE count during those periods, regardless of what happens after the reference period. So that's a static determination. A lot of PEOs are providing the information to their clients, which is very helpful, and payroll companies as well. Next is the FTE reduction exceptions. They're added back to the FTEs during the covered period. So if in fact you qualify for a safe harbor, an exception, or the rehire rule, what that means is you add the number back to the FTE count during the covered period, so you get a favorable comparison to the reference period. So that's the way that works. Anytime you're making a change based on the rehire rule, the safe harbors, or the exceptions, you increase the number during the covered period, which hopefully will get you closer to 1, meaning there's no reduction, or if you're in excess of 1, that would be 1 as well. So that's the way that works. And then the 4 reduction exceptions, we put here, note what must occur during the covered period, because we get these questions about how it works. So we have an example here which sort of highlights the importance of focusing on the covered period. So here the borrower uses a reference period. They use the January to February 2020 reference period, and their covered period, you see here, is April 15th to June 9th. On the end of March, an employee voluntarily resigns, right? We know that a resignation is one of the exceptions if the employee resigns. We just talked about that on the prior slide. But here, the borrower would not be able to eliminate the reduction because a resignation did not occur during the covered period. And so that exception talks about employee resignations during the covered period. So it's important to, when we mention these exceptions, we focus on when the act occurred or when the thing occurred, because that will determine the eligibility for the exception. The next question is one that really goes to the heart of why the 24-week period came into being. And so borrowers were having trouble, that Congress thought borrowers were having trouble getting full forgiveness with using the 8-week period because a lot of businesses were closed and for a variety of other reasons. So they expanded it to 24 periods with the PPP Flexibility Act. So the way that helps borrowers is that the gross spending during that 24-week period is your starting point in the loan forgiveness calculation. So once you get to include 24 weeks of expenses, and your loan was based on the equivalent of, call it 10 weeks, right? 2.5 months, so about 10 weeks. You can see now you're substantially likely to get full forgiveness because you're spending 24 weeks when you only need to spend 10 weeks to get forgiveness. So you have a lot of margin for error here. You can suffer some reductions on headcount reductions or wage reductions and still get full forgiveness. So the question we get a lot is, well, who doesn't get full forgiveness? Why would I not get full forgiveness? We go around saying that almost everybody should be getting full forgiveness. If you're not getting full forgiveness, it's probably not in all cases, but probably a lack of planning to make sure you got it. The people who don't get it are the ones who have drastic headcount or wage reductions. And if you had those kind of reductions, then you're not likely to get full forgiveness. So this slide here just talks about the ways to eliminate the reduction calculation. This is not the EZ form. This is the main application form. And what you see here, the first is no reduction in employees or average paid hours. That's in bold there. And if you meet these three, you can basically skip this and you're done with the FTE calculation. Second is the first safe harbor, which is based on employee availability. No, this is the business or returning, the business operations. And then the second safe harbor is the other one. So we just wanted to show you the application and how you can avoid doing all the work altogether. Obviously, if you can get in the EZ form, which we think you can, many people will be able to fit within the EZ form. That will simplify the task of filling out the loan forgiveness application. So we turn to the next slide. And so these are some general considerations. Here, the borrower can submit loan forgiveness application at any time, even before the end of the covered period. Again, if the borrower has used all the loan proceeds for which forgiveness is sought, but they must account for any wage reductions in excess of 25% through the end of its covered period. So if you have a 24-week covered period and 12 weeks through, you've achieved full forgiveness, you're going to go ahead and apply anyway, even though you're not done with your 24 weeks. You will, but if you did reduce any wages below 25%, you'll have to carry that through for the rest of the 24-week covered period. So you will suffer a reduction in forgiveness for the full 24 weeks. Strange here is that they did not mention any FTE reductions. Now, maybe that's going to come, they'll catch this and fix it at a later time. Maybe they don't care. But they didn't mention FTE reductions here. But despite this, we still don't think it makes sense for many people to apply for forgiveness mid-covered period. There's really no, other than being antsy and wanting a decision and wanting it resolved, there's no reason to rush the application. Second point here, no change on this one. The amount forgiven is tax-free, but you do lose the deductions for the expenses that relate to the amount that's forgiven. And that's that IRS notice that came out 2020-32. So the key points here are that you should eliminate your 2020 deductions even if you don't get a loan forgiveness decision until 2021. Either, let's say you wait after the 24-week period, you have 10 months after the end of your covered period to file the application. Even if you file it sooner, the SBA, your lender has time, the SBA has time. It may take a few months for you to get a decision, particularly if your loan exceeds $2 million and you're being reviewed. So in that case, the tax law does require you to eliminate your deductions in anticipation of getting that loan forgiveness decision. And if the decision comes out to be different than what you expected, you can amend your tax return at that point. Legislation is being considered in Congress to restore the deductions. So there's still a very good chance that the Congress will act to restore those deductions for taxpayers. And because if they don't, then borrowers are going to have greater taxable income because they have less expenses to deduct. And so they have the same amount of taxable income they would have had, but they're going to lose the benefit of all those deductions that relate to the forgiven income. So some senators and congressmen have stated that it wasn't the intent of the CARES Act. And I think the legislation was just pushed through rather quickly. They didn't have time to account for all the collateral effects. One of those collateral effects was Section 265 of the Internal Revenue Code, which denies those deductions relating to what they call a tax-exempt class of income. Finally, before I turn it over to Chris, I want to mention here that the SBA and Treasury announced last day or two, I think it was 2 days ago, that they will publicly release the information about borrowers whose loans equal or exceed $150,000. So they're going to be revealing quite a bit of information. They're going to reveal the name of the borrower, the address, the NAICS code, that's the business code, the zip code, the business type, the demographic data if it was provided, nonprofit information depending on the borrower, the amount of jobs supported, and the loan amounts in the following ranges. And so they have these buckets here. And the reason they did that was because they realized they're providing, to a lot of businesses, this is proprietary confidential information. If once you know their loan amount, you can back into their salary expense, right? Because it's 2.5 times the salary expense. So they did try and anonymize the data a bit by putting these buckets in. So, you know, you won't be able to that easily calculate the someone's expenses by looking at their loan amount, because they're within the bucket. You can only determine it within a range, and the bigger you get, the bigger the loan, the bigger the range. So it makes it harder to figure out with the larger loans. It's interesting just in terms of statistics, the types of loans that were issued. The loans above in all those categories, so loans of 150,000 and above account for 75% of all dollars loans from the program. So I thought that was interesting. So we put that in the slides here, that only 25% of the loans approved so far are under $150,000. So most of the programs going to larger borrowers rather than the under 150,000. For loans that are $150,000, your name will not be disclosed, your address won't be disclosed, but they were going to aggregate the data and release it by zip code, by type of businesses, well, similar to what they've done in the past. Nothing new there, but the key is that they're not going to disclose your name and address and other information about your business. Whereas if your loan's over 150, that will be made public. I don't know, it'll provide an opportunity for some people to quote name and shame that they've said they're going to do if they find out some businesses are getting these loans. But I don't think there's any shame involved in taking out a PPP loan. I guess there might be if you get some bad press if it turns out you didn't need the loan, that FAQ 31, but that's a question for another day. So with that, I think we'll go to the next slide, and I'll turn it over to Chris, who's going to talk about loan repayment.
Thanks, Dan. Much appreciated. So good afternoon, everyone. Covering loan repayment, the next question as you think through the forgiveness process is what is the actual timing of having your loan forgiven? And if a portion of that loan isn't forgiven, at what point in time do you start paying that back? So the clarifications that have been given are: one, after you've actually submitted your loan application, your forgiveness application, you'll have 60 days, the bank will have 60 days from receipt of that application to render a decision to the SBA. Ultimately, the SBA will also have an opportunity to render their own decision as well after receiving and reviewing the bank's application, the bank's decision. So when you think about it, after you've actually submitted your application, there's up to a 5-month waiting process to get to a point where you have forgiveness and the process has concluded. At the bottom of the slide, what you'll actually see is there's also some additional timing. So when your covered period ends, you have up to 10 months to actually submit the application to the bank. So when we add all this together, after the end of your covered period, you could be somewhere around a 15-month period to actually have the entire process go through. That all said, we don't really expect that the banks or the SBA are going to utilize the entire time frame that they have. So we expect for the smaller, less controversial loans, so to speak, that the lender will get through it as quickly as it can. The lenders may be somewhat overwhelmed depending on the timing of when the applications come in. We actually think for small loans, especially loans that are under $2 million, where the SBA has already indicated that they're not going to evaluate loans for eligibility if it's under $2 million, we think that this may be as simple as a check the box, right? The SBA is going to kind of just go through, make sure it's completed, and it could be a very, very quick process. If you have a loan that's over $2 million, it is certainly possible that the SBA will take more time. They have not issued any further guidance on how they plan to review those loans or what they're going to be looking at. Our suspicion is that it's primarily going to be focused around eligibility. That the banks will be really kind of tasked with making sure that the loan application, the forgiveness application is complete, that all the documents have been provided, that it's tactically accurate, and that we would guess that the SBA would focus around eligibility. So when you have your loan, once your covered period has ended, as I'd mentioned before, there are no payments of principal and interest until such time that a decision has actually been rendered. So if you actually do believe that you will have a repayment of your loan of some amount, you have up to 10 months from the end of your covered period to delay the process, right? And then allow the process to conclude. Once the SBA has concluded one way or the other, at that point in time, you're going to have to start servicing that loan and servicing the debt. And the SBA can, as we mentioned in the slide, can either approve it in whole or in part or deny it. They have full latitude for everything in between. Next slide. So when it comes back to documentation requirements, there's really not a heck of a lot here that's changed since our last webinar. The advice that I give is, think about this for those of you who actually receive a financial statement audit. Think of it no different than a financial statement audit, right? You're going to keep all of your payroll documentation, whether it's 941s or whatever typical filings you make, and have that available when it comes to validating payroll costs. Bank statements, third party payroll provider information is also information they have to keep handy. It's been clarified that the banks are permitted to accept third party payroll information from reputable third parties. So basically, as long as you have your payroll reports from your ADPs or Paychecks of the world, whatever it may be, TriNet, that'll be sufficient evidence for your payroll costs. On the FTE side, what's interesting, what we've come to find is almost all of the payroll companies now are putting together custom reports for their clients on FTEs. So before you start digging in and trying to calculate your own FTE and headcount, your average FTEs during your covered period and your reference periods, talk to your payroll company. Most of those companies will retain the data. They have to retain the data in order to calculate those FTE counts. And they may, at the press of a button, be able to give you all of those reports. We've been seeing that come out. Not every payroll company has completed it yet. They're all kind of still working through the reports, but we've seen some coming out, and they look pretty accurate, pretty effective. The banks and the SBA do not have to accept that document as sort of a reputable third-party document. They may be able to or permitted to audit beyond it, but it would certainly be a great starting point for you. Next slide. When we get to non-payroll costs, again, not a lot of changes from the last presentation. When we have things like mortgage interest payments, rent payments, utility payments, the big pieces to keep in mind is, one, these are agreements that needed to be in place as of February 15th. So if they are new agreements that came into play after that date, they are not going to be subject to forgiveness. So you want to make sure that you have, canceled checks available, the underlying contracts or lease agreements that you entered into proving the date that those agreements started. And bank statements showing that the actual disbursements happened and happened either during the cover period or during the requisite time frame after the cover period to allow them to be permissible. Next slide. So when we think about document requirements and document retention, the SBA has come out and indicated that they expect you to retain these documents for 6 years. And what that tells us is, while there is a very discrete period where the SBA is going to be evaluating these applications and they have 90 days to either accept or deny them, their ability to come back and get a second bite of the apple will last far beyond that 90 days. They can, at their discretion, come back to the company and ask for underlying data up to 6 years after this loan has been forgiven. So you want to make sure that you've got good data, you've got good documentation, and you have it saved, and you save it for that 6-year period. Things that you're going to save, it's no different than the other pieces that we just talked about in terms of documentation, but it's also the schedule, the PPP Schedule A worksheet, and any support that you have for things like FTE levels. We definitely think that it's going to be important to make sure that you have good documentation and you retain that documentation on eligibility, and making sure that you have everything documented in terms of what was known or knowable at the time that you made the application. And in previous communications, we've said anything that you can do in terms of formalizing that documentation is always going to be helpful. So, for example, if you actually keep board minutes, making sure that the information relating to eligibility was actually documented in those board minutes. As we say here on the slide, an SBA representative is going to be able to have access to that information up to that 6-year period, so have it available. Next slide. So I'm going to kick this over to Matt Walsh to handle the updated PPP loan application.
Thanks, Chris. So as we've talked today through sort of the changes and the application requirements, one of the things that they've also changed is now that there are 2 applications available, right? And for most borrowers, you'll want to be in that EZ. And I guess the question is, well, how do we get into that EZ form? And just a reminder from the, from some of the previous webinars, or if you've reviewed the application that was released, quite a few weeks ago now, the PPP loan forgiveness application, the standard form, comes with 4 separate parts. The loan forgiveness calculation form, the Schedule A worksheet, which has underlying calculations for the Schedule A, and then the optional demographic information. The SBA only requires that parts 1 and 2 are required to be submitted to the lender. Remember, the banks ultimately have the overarching responsibility to approve the loan. So just because the SBA is requiring a minimum amount of the loan forgiveness calc form and the Schedule A, the banks may also request the Schedule A worksheet or any of the underlying support that they wish, that they believe that they have a responsibility to review. So keep that in mind. When it comes to the Form EZ, there's only 2 parts to it: the loan forgiveness calculation and the optional demographic information form. And can we go to the next slide, please? What we've done here is we've included the first pages of each of the forms just to give you a sense of what is different between the 2. And apologies if these are a little bit small on your screen now. You should be able to see them in Zoom with the slide deck that's copied in. But essentially, what you're looking at is the general information about the loan itself is pretty much identical between the 2 forms. And then when you get down into the actual calculation form, the difference between the 2 is that the one on your left, which is your standard loan forgiveness application form, includes the FTE reduction calculation lines, and it includes the salary and hourly wage reduction lines. Whereas the Form EZ removes those lines under the assumption that those aren't applicable. So for many borrowers, we're now kind of evaluating, well, how do I get into the eligible group that can file that Form EZ? And can we go to the next slide, please? Thank you. So am I eligible to utilize this form? There's been, since the form has come out, we got the form itself, we got a couple of IFRs, we have the instructions to the form, but and what we've gotten from all of this is that borrowers must certify to one of the following 3 options, which means you need to check one of the following boxes in order to utilize the Form EZ. The first option is that you're a self-employed individual, independent contractor, or sole proprietor. You didn't have any employees at the time you filed the loan application, and you weren't including any employee salaries in the loan amount when you applied for it. So for those individuals who are Schedule C Schedule C filers who calculated their loan amount on the basis of their 2019 Schedule C, you can utilize this form in all circumstances, provided that that is your fact pattern. And what this form will allow you to do is it'll allow you to enter your owner compensation replacement amount, and hopefully, in almost all circumstances, receive full forgiveness. The second option is a 2-part requirement. You have to be able to satisfy both of these requirements to select this option. The first of which is that you did not reduce your salaries or hourly wages of any employee by more than 25%. So essentially, you are certifying that you do not have any salary or wage reductions during the covered period as compared to the reference period of January 1st to March 31st. And you also must certify that the borrower did not reduce the number of employees or the average paid hours of employees between January 1st, 2020 and the end of the covered period. I'll pause right here just to say one thing, because what's interesting is for this option, we've now introduced yet another period to consider. The idea of January 1st, 2020 and the end of the covered period was not previously a consideration for any of the different exceptions or safe harbors, but the Form EZ instructions and subsequently the IFR, which came out this morning, solidified this, that this is the way that you'll look at it. If you didn't reduce any salaries and wages more than 25%, and you didn't reduce number of employees or the average paid hours, which essentially calculates out to the FTEs, between January 1st and the end of your covered period, you can claim this. You can ignore reductions if they arose from the inability to rehire individuals who were with you on February 15th, and you were unable to hire similarly qualified individuals to fill those positions. And you can also ignore reductions in an employee's hours that you offered to restore and the employer refused. So that's your second option for utilizing the Form EZ. And then the third option, which is the most intriguing, and we've already talked about this a little bit, but we thought it good to re-highlight this one. So this under the third option, you would have to meet the following two requirements. The first one is the same, that you didn't reduce salaries and salaries or hourly wages of any employee by more than 25%. Again, that's the standard salary and hourly wage reduction calculation. So you're certifying that you did not do that. And then the second requirement here to meet option 3 is that the borrower was unable to operate during the covered period at the same level of business as before February 15th due to compliance with requirements established or guidance issued between March 1st and December 31st by our 3 governmental agencies relating to maintenance of the standards of sanitation, social distancing, or any other customer safety requirement. And this was very vague when it came out on the 16th, and we spent a good amount of time analyzing this and taking this apart a little bit and trying to figure out exactly what they were getting at here. And just this morning, we got some further thought about how they think about this, and they've clarified that this is either direct or indirectly affecting borrowers can make this claim. Can we go to the next slide, please? Perfect. And what we did here, and we referenced this example a little bit earlier in the slide deck, but we wanted to include it here. So when considering whether or not a borrower meets that third option for filing a form on an EZ, this is the example that they provided. So a borrower is in the business of selling beauty products, both online and at its store. During the covered period, the local government where the store was located ordered all non-essential businesses, including the beauty business, to shut down their stores based on COVID guidance issued by the CDC. Because the borrower's activity during the covered period was reduced as compared to its activity before February 15th due to the compliance with that order, essentially they're saying that the borrower satisfied the Flexibility Act's exemption and will not have to have its forgiveness amount reduced because of any reductions in FTEs. So again, getting back to this this third option, this opens the door for those borrowers who are in states whose state or are in cities whose city government issued stay-at-home orders, or non-essential businesses to be closed, or any regulation that referenced the guidance under those 3 federal agencies in claiming that businesses must shut down. So this is a fairly significant development here for businesses and borrowers, and we think that many of the borrowers who would otherwise have been in a little bit of a gray area with this would fall under this this option and be able to utilize the Form EZ. And as a reminder, the benefit of utilizing the Form EZ is that you no longer have to prepare and provide those FTE calculations and go through the process of reducing your loan forgiveness amount for FTE reductions. With that being said, however, next slide, please. There is always a catch, and the catch is the additional documentation requirements. And Chris covered all of the documentation requirements a few slides ago for the standard application process. And what the Form EZ has asked is that borrowers who are filing this form must maintain some additional level of documentation. So if you're filing the Form EZ because of a claim around around that you didn't reduce the number of employees or average paid hours, you do need to include and keep documentation that proves that out between 1/1/20 and the end of the covered period. This documentation must include payroll records that separately list each employee, show the amounts paid to each employee between 1/1/2020 and the end of the covered period. We presume this will also need to include, this is not in the direct words, but again, we presume this will also need to include proof that they weren't reduced in terms of their hours, because you're certifying that you did not reduce, you reduced the number of employees or their average paid hours. So when it comes to that, again, that's another decent sized lift just to make sure that you have all of that documentation together, and the bank may or may not ask for this. The second piece here is in regards to that third option that we spent a little bit of time on, and it requires that you are documenting the certification that you were unable to operate between 2/15 and the end of the covered period at the same level of business before 2/15 as a result of the compliance with the with those three governmental agencies. The documentation, and this is another important note here, it must include copies of the applicable requirements for each borrower location. So every location that you have that had to shut down as a result of this, as a result of stay-at-home orders, it must be documented, and you also must have relevant financial records to support the fact that your business was not operating at the same level of business activity. So keep that in mind, that the requirements, although the documentation is a little bit hefty, the whole process in general just comes with a hefty documentation. So we don't necessarily think this is a little bit more onerous. It just adds a little bit of wrinkle and a little bit of a little bit of discussion about what you're going to need. So make sure that you're talking with your advisors and those who are helping you through this process, and making sure that the documentation you have for the certifications that you are claiming, whether they be regarding the Form EZ or regarding the regular form, and you're making stances on particular FTE exceptions, or that certain salary and wages weren't reduced, and these are the reasons why. Just make sure you are talking with with your advisors to make sure that everything is everything's documented well, and kept in proper order for the bank's review, the SBA review, and down the line, if the SBA chooses to send a representative to look at it further. So with that being said, I'm going to turn it back over to Chris just to talk about a couple of quick things that are on the horizon here.
Thanks, Matt. Next slide. So, as we've come to learn with the entire PPP process, is that every day is a new day, right? And it seems like every week we're coming out with new information, new programs are percolating, new rules are coming out, new interpretations, and certainly today is no different than the other days. So the first thing we've got right now that we're sort of monitoring is the Main Street Lending Program. You've all probably heard about this. It's been kind of lurking around since early April. It's a program that was introduced a few months ago and never really made it to prime time. Basically, there's been a lot of public comment and analysis and adjustment to the program to try to get it to a point where it's appropriate and useful to the middle market. The Main Street Lending Program is designed for primarily to me for the upper middle market and the middle market. There are three facilities for commercial businesses: the MSNLF, the MSPLF, and the MSELF. The facilities are actually based on EBITDA. So you can have loan amounts as low as $250,000 up to $300 million, depending on which facility you're in. These are not forgivable loans, and they do require security, whether it be personal guarantee or assets of the business. For the smallest loan facility, which is the MSNLF, the minimum loan amount is $250,000 based on 4 times your EBITDA. So what that's implying is that you need EBITDA, you need to be profitable to get these loans. You need EBITDA of at least, call it $65,000 in order to potentially benefit from the minimum loan amount of $250,000. These are generally 4-year loans. And I think the interest rates hover around 3%, 3 to 4% but it's based on LIBOR. So every one of these are these loan programs are a little bit different. We also have 2 different not-for-profit facilities, and they're still accepting public comment on those facilities. So that's the non-FL and the NOELF. So those would be facilities for not-for-profit institutions. The Main Street lending program has been opened up to the lenders to participate. We've heard some lenders are not participating in this, some lenders are, but borrowers are not yet, as of right now, able to actually apply for these. So we're hoping to see these become available soon. Next slide. So earlier this week, we got our first word of the P4, which is the Prioritized Paycheck Protection Program. So this is a bill right now that's kind of growing out of Congress. It has not passed either the House or the Senate. It's kind of just getting put together at this point in time. And basically what we know is, the SBA, when they put together the PPP, there was obviously 2 tranches, and it came out to a total of something like $580 billion worth of money that was available to the public for PPP loans. As of today, there's about $75 billion that had not been utilized. And one of the things that this program is set out to do is to actually allow some companies, certain companies, to be able to get a second PPP loan. Our suspicion is that they want to try to at least be able to utilize every last dollar of what was set aside for this program. This may be an avenue to do it. So if you're a business that has under 100 employees, you may be able to apply for a second loan. In order to qualify right now, as this act sort of stands, is you've got to be able to demonstrate at least a 50% decline in revenue as a result of COVID. Now, that's a very broad statement, and there's a lot of questions that would come from that. And all I can say right now is this is in the early phases of this bill. We don't know where it's going or how it's going to change by the time it gets to the end, or if it ever even makes it to the floor. Just know that it exists and it's out there. What we've come to find is bills like this can move quickly if they do get steam and they get some support. Mnuchin has come out and said that he's not opposed to it, although he hasn't actually said that he supports it. So that's at least one indicator of where we're at with this thing. It's a little bit lukewarm, but we'll see. We're going to continue to watch it for you, and certainly pay attention to it, because if you have under 100 employees and suffered a significant decline in revenue, there could be more money in the coffer for you. Next slide. So we're going to push over to questions, and I guess I'm going to go give it to Dan.
Great. So we're right on time here. We allocated 30 minutes for questions, so we're on time. I'm going to try to moderate the questions. We have a couple hundred questions, it looks like. I'm going to moderate this while we present it to everyone. So the first question is, someone's using the 60-40 rule, and they want to know if you can spend more than 60% of the loan on payroll costs and less on the overhead items like utilities, rent, and interest.
Absolutely.
Yeah, there's no upward ceiling on payroll costs.
Yeah, you could spend 100% on payroll and not on any of the other costs. But you do want to accumulate all the costs when you're calculating this, just in case you did have an FTE reduction. So that percentage will be reduced. So you want to continue to accumulate all of your costs.
Next question is, do you have to fill out the FTE safe harbor questions if you're not asking for safe harbor forgiveness or forgiveness based on the safe harbors?
No, I think if you're filing the long form application, I'm calling it the long form because it's not the easy form, and you're doing the FTE reduction calculation, if you're not utilizing the safe harbor piece, there's no need to complete that.
Great. And the next question is, can 100% of loan forgiveness be used on payroll costs?
Yes. I mean, there's no upward ceiling on payroll costs. You don't have to use any. You don't have to utilize any non-payroll costs in order to get 100% loan forgiveness.
Right. And in fact, you're likely going to exceed 100% of the loan if you use a 24-week covered period. Mm-hmm. Right. That's the benefit of using the covered 24-week covered period, is you get to spend. You get to include your payroll and non-payroll for the full 24 weeks, the amount of which will greatly exceed your loan amount. And even if you have any reductions for headcount or wages, you're still likely then to exceed the full loan amount which means you're going to get full forgiveness, 100% forgiveness. I just threw in an answer to 2 other questions there, by the way.
Thanks.
Next question. I know, Frank, you get this question a lot here. Says, we applied for the PPP loan and we got it. I understand the EIDL loans are back up and up to $2 million. Can we apply for that as well?
Yeah, you can apply for that. I don't think you're gonna get $2 million. I think they're capping it at 150,000, but yes, you can apply for the EIDL loan, but that has to be paid back, remember. So that's gonna be, I think, a 3.5% interest rate, paid back up to 30 years. And I think there was a requirement at one point, you could not use it for payroll, but I think now the requirement is you need to use it for working operations. But yes, you can apply for that EIDL loan.
Next question is one that relates to the new IFR that came out. I addressed it, but one of you during the presentation, but feel free to address it. You guys, can you apply for loan forgiveness between 8 weeks and 24-week periods? Or am I stuck with one of those 2 periods?
So you can, the covered period was automatically extended to 24 weeks unless you elect to apply to retain the 8-week period. However, in the new IFR indicates that you can at any point in time during your covered period apply for forgiveness. So that would imply that if you believe that you've come to a point where you have 100% forgiveness in week 12, you can go ahead and start your application and get it going. And to your point, Dan, what's the benefit? There's really, I wouldn't say there's necessarily any benefit to doing it early, other than there will be companies that are just motivated to try to get this done so they don't have to sit on these webinars anymore. So, you know, those folks will probably want to get that done sooner rather than later. There could be some motivation to do it as well if you want this cleaned up prior to your fiscal year end, whether that happens during the year or whether that's December 31st, if it's a calendar. Just, you know, again, if you're a company that has like a formal audited financial statement, just don't want to have these on the books, don't want to deal with this, you know, having it done during the year might be advantageous.
Well, Chris, let me just stop a second there, because I did see another question. So you may want to cut it off in the middle. Like if you pass the 8 weeks, you need 12 weeks to get the full use of the loan. If you're planning on having some kind of a furlough before the 24 weeks is up, you might be able to, I mean, my thought is, can you say you know you're going to furlough people, you're just barely getting there, you want to use the money up, so you wait 12 weeks, and then you decide you want to lay everybody off in week 13. You can apply in week 12 for forgiveness if you used all the money, and then you don't have to worry about keeping the employees around, because every week you keep them around, doesn't that reduce the potential FTE count?
Yeah, it does. And it's interesting because that's the one thing that they haven't addressed in the IFR that came out this morning. That they certainly addressed that you're able to apply midway through the period. The only caveat to which was what Dan talked about earlier, which is that if you have salary reductions, you have to carry them out through 24 weeks. What it didn't indicate is how to deal with FTEs in that scenario. So I guess we're in a little bit of a holding pattern on that one. Is you can definitely do it. It's just unknown on how they're going to apply the FTE rule to that circumstance. Now, if you're in a position where you're able to claim one of the certifications required to do the Form EZ, it almost seems like you pair that with the 12 weeks and you should be good. You know, it's just a matter of how they're going to look at the FTE piece on that.
And the next question is related to this is there any deadline that borrowers have to choose between the 8-week and 24-week period?
I haven't seen anything that indicates that the borrowers have a set period of time to go back to the lender to confirm that they're sticking with the 8-week period. Again, the 24-week period is an automatic extension. So if you do nothing, you get the 24-week period. You have to affirmatively elect the 8-week period. But I don't know that I've seen anything that indicates that there's a deadline. And the banks that we've been dealing with, at least the clients that have been reaching out to the banks, they've all kind of come back and said, look, we're not even ready at this point to accept an application. So just sit tight until we have more guidance. So I think it's fairly fluid right now.
Yeah, I haven't seen anything either, but as you were talking, Chris, it struck me that there might be sort of an implicit deadline, because you have 10 months after the end of your covered period So technically, right, you'd be after 10 months after the 8 weeks is when you'd be stuck using that. I don't think anyone's really going to be impacted by that. Hopefully everyone's got their application in at that point, but just doing the math, I guess that would be a practical limitation. Next one here is, this is a longer question, comes from Neil. Neil says, an employee who made more than 100,000 in 2019 was terminated in March of 2020. The employee was given severance of, call it 20,000 because it's over the 15,385, payable over 3 months. Can this employee be paid the entire amount over the 8-week period, or must the severance be capped at the 15,385? So what happens if you pay more than the cap amount is what I guess the nature of the question is. Well, I'll take that one. So I guess I've had time to think about it since I read the question. The answer is you can always pay more than the caps. You just won't get forgiveness for the amount of the you only get forgiveness up to the amount of the cap. So you're welcome to pay more, but you just cannot include that in your forgiveness application. So that's a good question. Next one here. That's just a calculation. The question is, it goes to the calculation of the covered period. The way I'll just address this, the way the 8-week covered period and 24-week covered period works, it's 8 weeks and 24 weeks. So if your covered period starts on a Wednesday, that's the day you first received a disbursement on your loan. Then you look 8 weeks later and it ends on a Tuesday, or 24 weeks later ends on a Tuesday. So that's the way the 8-week covered period works. If it starts on a Friday, it ends on a Thursday, 8 or 24 weeks later. Then next one is, if we restrict overtime during the forgiveness period, is this still considered a wage reduction? This, I guess, has to do with the rule about the base period, looking at the base wages in the covered in the first quarter.
Yeah,
Well,
go ahead, Chris.
The wage reduction is going to be based on your actual hourly rate, not on the gross salary that you're paid.
Right. Yeah. Well, let's take the case of on the hourly rate and then also a salaried employee. I guess the rule goes to the base salary, not the overtime is not included.
Right.
So if you're paid $50,000 a year, it's based on 50,000. If you're paid $10 an hour, it's based on the hourly wage.
And when you're calculating FTEs, you're only using 40 hours. You're not using, if they worked 50, you're not going to include the 50 hours as their hour if you're calculating the hours for FTE.
Right. The next question comes from Dave P., someone I know very well. And so Dave asked a question, very good person here, very kind-hearted, sensitive, sweet, nice person. Dave, hope you're paying attention.
Oh, wow.
Just joking here. So Dave, the question goes to the June 30th restoration date on the rehire rule. It says, if you would use the 8-week period, are you using the June 30th restoration date? And the answer is no. The IFR clarified what was, it's December 31st, regardless of the covered period you use. And the slides were inaccurate on that point. And again, we revised these slides this morning to account for the new IFR. So we missed that in 2 spots. I've since corrected that. I'm going to try and make sure the updated slides are on the web so everybody has that. To be clear, it's a December 31st rehire rule date. It's not a snapshot approach like it used to be in an older IFR. And it says you look at the, if you restore the wages or the head count by December 31st, regardless of whether you use an 8-week or 24-week covered period. Next question talks about furloughing employees. They furloughed their entire staff. They hired them back for 8 weeks after they got their PPP loan. However, after the covered period, they don't think they can sustain their operations, and they're going to have to furlough these employees again. What is the effect on the forgiveness if they furlough these employees after the 8 weeks?
Yeah, the calculation, if you utilize the 8-week period, will look solely at the 8-week 56-day period for your FTE number. What happens after that period doesn't have an effect on the mechanical nature of the calculation. So if you have to furlough individuals again after the 8-week period because the business hasn't picked back up, and you're still affected as a result of this, then you won't be penalized. And in addition, if the revenue numbers haven't picked back up and you're in that position, you may also be a good candidate to select one of the options for the EZ form, which would preclude you from needing to go through that calculation, entirely.
Okay, next question, it says, if you received your loan prior to June 5th, do you need to do something special to get the 24-week covered period or the 8-week covered period?
So there's nothing that you need to do. It's extended to 24 weeks, but if you did receive your loan prior to June 5th, you don't automatically have a loan that is a 5-year term. Loans received past June 5th have a 5-year repayment term. Prior to that, technically, I mean, I think all the banks were using 2 years for the repayment term. So you do have to go back to your bank, and the guidance that we have right now says you have the right and ability to negotiate your loan term with your bank. What we've been hearing anecdotally from the banks is they're just kind of making a blanket statement, most of them, that they're just going to a 5-year term for all loans because they're not going to penalize companies that got a PPP loan prior to June 5th. But you do have to make sure, you do have to proactively go out to your bank and make sure that your loan term is extended.
Yeah, so practically speaking, I don't know that that's going to have a great impact. If we think most people are getting 100% forgiveness, they probably won't care, right?
Correct. I mean, it's only relevant if you actually think you're going to have a loan that you're going to be repaying. And to your point that you made before, Dan, I mean, it's hard to see. I think that we're at a point now with all these changes that, companies that are going to be repaying some of this loan, it's going to really be edge cases.
Right, okay, the next question here comes from Richard, and he says, is there a prescribed method for notifying unemployment? So he's talking about using the safe harbor method, and how do we go? Is there a method to notify unemployment? I personally haven't seen it. The rule just talks about notifying them. I know the unemployment offices have a method. I think they reach out to the employer in the ordinary course anyway, to make sure to give the employer a chance to object. And I know, I have seen cases in a prior life where people have challenged unemployment for certain employees who they let go and for cause, and then the employee says they were terminated, and the employer doesn't want their rates to go up. So there is a process. If you reach out to the local or state unemployment office, I'm sure they have rules on how to go about doing that.
Yep. Yeah, that's all on the local level.
Yeah,
right.
And that goes to where you're not hiring. You hire somebody back, or you want to, and they refuse. The employer should be discussing that with their employee, that they will be reported to unemployment. So that, because I saw a question here, if the employers are making more on unemployment and they don't want to come back, that's not an excuse not to hire them back. So you will have to, if you decide to hire them back because you want to keep your FTE count up, you'll have to notify unemployment. So there's a couple questions on that, Dan.
Yeah, the next question comes in from Lorraine. She's asking about the FTE exceptions here, and she says, what about an employee that retires and/or doesn't want to work? We have a couple of semi-retired folks that work as needed. So how does that work when someone voluntarily says, I'm not coming back?
That meets the voluntary exemption, doesn't it? Where they voluntarily resigned.
Yeah, or voluntarily reduced their hours.
Right. So they were within the exception.
Right.
The key is just putting that, so someone's retired, said they're retiring, or that's really, you fit them in the bucket of someone who's voluntarily saying, I'm not coming back. The reason they're not coming back is irrelevant. It could be that an employee goes out on military leave. We got this question a few times, right? They join the Army, well, then they've chosen not to work. There are many circumstances where you might conclude that it's voluntary. You just need to put it in that bucket. Look at the exceptions in the safe harbor and see if your fact scenario fits within those exceptions. Next question, it talks about the amount of spending to get full forgiveness. I think we addressed it, but I'll mention it because I think it'll be helpful to hear it in this format. If qualified spending exceeds the loan amount, is the calculation reduction of forgiveness, does it start with the loan amount or the gross spend amount? So for example, they borrowed $1 million, but they have $2 million of qualified spend. Which is a starting point, and how does the FTE reductions play off of that?
Yeah, so
Matt,
the starting point would be, yeah, the starting point is the spend here, right? So in this circumstance, the $2 million is the eligible payroll cost, or payroll and non-payroll cost, whatever it may be. That'll be the starting point for reductions for salary or wage or for FTE. So in this circumstance, even if you had a 50% reduction in for your FTE count, 2 million times 50% is $1 million. You would still be eligible for full forgiveness on $1 million loan.
Right, okay, and I guess the answer there, you know, they made up numbers, but if the loan was $1 million, their spend should be more than 2 million, right? Assuming unless they had layoffs, in which case they would spend down to 2 million.
Right.
Next question talks about what are permissible expenses for the overhead costs, right? The non-payroll costs. And they want to know if they can include software expenses that are integral to the business, like AWS for a software platform.
Yeah, I mean, when you look at non-payroll costs, you know, we're generally talking about rent, utilities, bank interest. You know, when you look at utilities, and we've seen this question specifically, actually, AWS, quite a few times. You know, at this point in time, when you look at utilities, it's a relatively narrow set of utilities that they've come out and talked about. Electric, water, maybe
Gas.
one other.
Gas, transportation, phone, and internet.
Transportation.
Yeah. So you know, AWS really isn't going to fall into any of those categories, and I don't think if unless you can clearly put an expense into that category, you have to assume that it's not. I mean, we do look at cell phones and think that is phone, right? That seems pretty clear to us. But things like AWS is probably not gonna fly, and transportation is going to be relatively limited as well.
Chris, you want to just define AWS for some people who may not know what that is?
That's Amazon Web Services, so hosting expense. You know, and you know, we've seen a lot of questions around just general software expense, software as a service, hosting, and we're not really, at this point in time, we don't see any of that falling under internet, and certainly it's not going to fall under phone or electric. So we're going to say no. That's our view at this point.
Okay, next question talks about, this is an interesting question about the safe harbor and how it applies. And it says their loan was, well, it doesn't matter when the loan was funded. Their loan was funded, and there are various mandates and statutes that have closed or reduced their business and that have impacted their ability to rehire people. If those requirements are lifted prior to the end of the covered period, what does that mean in terms of the safe harbor? So do they have to meet that way? I know we've talked about this. Do they have to meet it for the entire term of the safe harbor, or if they meet it for part of the covered period? How does that work? Well, I know I talked about it with Frank and Matt, so one of you guys want to take that one?
All right, so I'll take a shot at it. Correct me if I'm wrong. I think we were discussing that if it's any time during the covered period that you had a reduction in your business or dip below the February 15th levels, that you would qualify for that exception.
Right, because it doesn't say the entire covered period.
It doesn't say the entire period. It says during.
Yeah, it's interesting because if it's a point in time, you know, if you think about it, I mean, that almost, what company can't really make the claim that at some point in time during their covered period, they were impacted by one of these, you know, one of these rulings that came out, or one of these, you know, policies that came out? I mean, wouldn't it potentially push everybody into an easy form?
Yeah, there's I think of that example when you throw a ball up in the air, and then the moment when the ball hits the peak of its ascent and then it drops, it's not moving, right? It's static. There will be a 1 second period in everyone's covered period when they can say it's worse than it was, you know, before February 15th.
Because they didn't even go as far as to define it as revenue, right? Like, hey, you had a revenue reduction. It appears as though they're just saying if you were disrupted as a business as a result of this at some point in time, then you're going to qualify. I mean,
but they do say some of your documentation includes financial records.
Right.
So I took that to mean if you can prove that you know, your revenue did go down by, you know, your financial records, you can say, hey, I've been harmed by this, or I've been impacted by it. And then of course you have to supplement that with, you know, a stay-at-home order or something for your state or your city.
This is one of those examples where I use my favorite example is only do what you feel comfortable when you're sitting next to your lawyer facing an SBA examiner in a conference room in Midtown Manhattan that's dimly lit, and you're asked the question about this. You know, you got to be able to answer with a straight face.
Remember, Dan said lawyer, not accountant.
One could argue if your building was shut down and you had to go remote because you couldn't get into your building. I mean, that's a disruption, right? That's not necessarily directly connected to revenue. Obviously, everything somehow comes back to revenue, right, as a for-profit business. But I just think it's interesting how broadly that was written.
And it could be profit too, right? Your revenue could be the same, but you're spending a lot more on sanitation and other expenses.
Yeah.
Right, yeah.
Or liquidity, right? I mean, your customers could not be paying you at the same rate they were. I think it's
Right.
so broad right now.
It is.
When they
I
clarify.
do believe there'll be some FAQs coming out on that specific topic.
Yeah, we had heard, does one of you want to comment on FAQs or the rumor about that?
Yeah, we heard a rumor that they were sitting on at least 20 FAQs that are supposed to be released in short order. The last FAQ we've gotten was May 27th, I think. So it's, I mean, we're rapidly approaching 1 month since they provided an FAQ. So it could have been a shift. We had heard that they were sitting on at least 20 right before the PPP Flexibility Act made its way through the House, and then they withheld releasing them because of that. So hopefully we get them soon.
Next one talks about the alternative payroll covered period. It says payroll is semi-monthly. Can you use that? This is something I know we've talked about before. It talks about if you pay bi-weekly or more frequent.
Right.
So therefore, if you pay semi-monthly, you would not fit within that because you're not bi-weekly. There's more than 4 weeks in a month, so you cannot take advantage of the alternative payroll covered period in that circumstance. Next question is, what if I use up all the PPP money in the first 11 weeks? You still want to wait for the end of the 24-week period to apply for forgiveness?
Yeah, I mean, I think we covered that earlier on, right? I mean, it's a matter of preference. One might make the argument that there's no rush, so just wait until the end of the 24-week period. Another might make the argument like just if you're motivated to get it over with and just be done with it, do it right when you feel like you've gotten to 100% forgiveness.
I feel like when I read the question, I think it's maybe worth saying to this person to remind them that the forgiveness calculation is not just based on the money you spend of the PPP, but it's your total gross spend. So even though you used up your PPP money, if your business is still running and you're making payroll, that counts in your forgiveness calculation. So you get to add those amounts in to your gross spend. And I think maybe that the question to me when I read it kind of assumes, that you're done if it's only the PPP money that counts.
Mm-hmm.
I think it's also important to keep in mind. I mean, you covered this in the presentation, but we have to watch this closely, which is, the current tax consequence of the PPP. And a lot of people will hear, okay, it's tax-free, right? When the loan's forgiven, it's not taxable. But to your point, Dan, if your company still exists and your company's still doing business and generating revenue, yes, the forgiveness of the loan will not be taxable, but the expenses associated with that loan will not be deductible. So a company that produces revenue and paid its employees will have a lot less deductions as a result of having taken this loan, and will have potentially more taxable income. So that's a real issue that people need to pay attention to.
But there is a bill out there that wants to make the expenses deductible. I was reading that the other day, so I'm not sure where that is yet, and how it's going to, if it's going to flow through or not. But if it does, then that's a tremendous windfall. Yeah,
they do seem to be pressing that, Frankie. We discussed that. There is a version of a bill out there. It's been drafted. The senators are pushing for it, so it's looking more and more likely that bill will pass at some point, probably as part of a larger piece of legislation. But our next question gets from Samantha. She's talking about the FTE calc and the covered periods. Maybe Matt, this is a good one for you. How do we calculate the FTE calc for employees who left within the first 4 weeks of the period? They would be 50% for the 8-week, or are they now 17% for a 24-week period?
Yeah, so I think this is another area where it hasn't, that if they're voluntarily leaving, you're going to get an exception for them to the extent that you don't replace them, right? So if taking that scenario where they left halfway through an 8-week covered period, you would have gotten 0.5 of an FTE, 0.5 of an FTE for them for the period in which they were there. It makes sense that the logic goes to the fact that you would be made whole for that employee if you weren't able to replace them. They voluntarily left, so you would get another 0.5 of an FTE reduction in the scenario of an 8-week period. In the scenario of a 24-week period where they were 0.17, you would get a 0.83 exception, or whatever you were able to replace them with. If you were able to replace them after week 12, you would get 0.17 for them, 0.37 of an exception, and then 0.5 for the employee you replaced them with for the rest of the 12 weeks. But that's the current thinking that we have with that. That's not something that is specifically written out anywhere in an IFR or in the application instructions.
The next question is one that I haven't seen before, but I think I understand it. So I'll answer the question, maybe let you guys jump in, correct me if I'm wrong here. It says, are employee owners of a C Corp only those that own 20% or more? And I don't think that's the case. I haven't seen anything defining that. The 20% I think relates to the application for the PPP, where they wanted 20% plus owners to sign the application, but that an owner of a C Corp can be a 1% owner.
Yeah, I mean, and this is kind of a controversial issue, especially if you think about the tech space that, where you have really, large distributed cap tables, you could have a lot of employees having very, very small ownership percentages of companies. There's nothing in the guidance that we have that has carved out people in terms of what is the definition of an owner. So our view right now is if you have an equity interest in the company, you're going to be an owner. So you're going to be falling under those ownership rules. Now, the 20%, to your point, that's just merely the disclosure of a 20% or more owner in the application process. That's that.
The application for the PPP loan, not the forgiveness.
Right, for the actual loan, right.
The next question talks about, this is an interesting question here. I know we've discussed this before. If we pay some of our employees cash reimbursement for use of their cell phone, is that considered cash compensation? When you want to take that, or you want me to take it? I'm happy to take it. It's I think they're saying here it's either going to be a utility, right, a phone expense, or going to be a salary expense. I guess the relevance is if you're dealing with an owner, I guess it could become relevant, right? Because there's caps on salary. If you're dealing with someone making 100,000, it could be relevant to which bucket you put it in. But if it's if you're imputing it to income and in imputed income, it's more likely to be a cash compensation because it's going to be on the W-2 as opposed to just a pure reimbursement that's tax-free to the employee.
Right. Yeah, Dan, I look at it. If it goes on the W-2, then it's obviously compensation. And if you're reimbursing them as part of a reimbursement program, then it's going to be considered a non-payroll cost.
Right.
And you could be up against that 40% limitation. So something to consider.
Next question is, if your utilities are paid as part of a homeowners association fee, how do you determine that? I guess this is a self-employed individual. Have you guys thought of that one before?
It's whatever they deducted under Schedule C.
Right.
So if they were taking the deduction on Schedule C for that amount, then that's the amount that they would be able to use for the forgiveness amount.
Right. Provided that it was in effect as of 2/15, they have some support for that piece, because that's ultimately what the banks are going to be looking for. They're going to look for proof that it was an obligation in effect of the company as of 2/15. So hopefully that the HOA provides a breakdown of what's related to electricity and what's related to the various utility costs.
That's what I was going to say. I think you're going to have to prove that your HOA fee actually did cover those costs. So you really need to cover a breakdown that shows it actually covers utilities and what that is. If there isn't, I don't know that it would actually count because all you've got is an HOA fee.
So I see we're at the end of the hour. I'll turn it over to Jessica, but thank you all for attending the webinar, and thank you 3 panelists for doing a great job here.
Great, thank you.
Thank you for joining today's webinar. We'll be sending out an email shortly with the recording and the slides later today. Have a great day.
Go on.
Bye.